Investing 10,000 in 2020-25 might seem daunting, especially with all the market noise and uncertainty. But if you approach it strategically, this sum can become the foundation for long-term wealth. Let's break down 6 powerful strategies that can make your 10,000 work smarter for you. The first strategy is diversification. Never put all your eggs in one basket. Spreading your money across different asset classes, stocks, ETFs, real estate, and even some safer options like bonds helps reduce risk. For instance, allocating a portion to an index fund exposes you to the overall market growth without depending on a single company. Stocks in emerging tech or renewable energy sectors can provide growth opportunities. Investment, while bonds and dividend-paying stocks offer stability. By balancing growth and safety, you're protecting yourself from the unpredictability of market swings. Diversification isn't just about different asset types, investment. It's also about sectors and geographies. Investing in international markets alongside US stocks can give you exposure to growth in different economies, smoothing out volatility. Next, focus on high potential investments. In 2025, sectors like AI, green energy, and biotech are projected to see massive growth. Investment, allocating a portion of your 10,000 to carefully researched high growth stocks or ETFs can generate significant returns over time. The key is research and patience. Avoid chasing hype or trending stocks without fundamentals. Look for companies with strong balance sheets, solid leadership, and a clear path to profitability. Consider dollar cost averaging to minimize timing risk. Investing a set amount periodically ensures you're not trying to perfectly time the market. High potential investments aren't just about stocks. Real estate crowdfunding platforms or REITs can also provide growth potential without the need for huge capital upfront. The third strategy is maximizing tax advantages. Using tax-advantaged accounts like IRAs or Roth IRAs allows your investments to grow tax-free or tax-deferred, even if your $10 is split between taxable and tax-advantaged accounts. And the compounding effect over decades can be enormous. Take advantage of employer retirement plans if available, especially if they offer matching contributions. It's essentially free money. Additionally, consider tax-efficient investments like municipal bonds or ETFs designed to minimize capital gains taxes. Strategic tax planning can increase your effective returns significantly over the long term. Fourth, investment. Maintain financial discipline and an emergency fund. Before going all in, ensure you have 3 to 6 months of living expenses set aside. This protects you from being forced to sell investments during a downturn. Investing with peace of mind allows you to stay patient and avoid emotional decisions. Discipline also includes tracking your portfolio, rebalancing when necessary, investment, and avoiding impulsive moves based on short-term market noise. Treat investing like a marathon, not a sprint. The fifth strategy is considering alternative investments. For those willing to explore, small allocations to assets like cryptocurrencies, commodities, or peer-to-peer lending can offer unique growth opportunities. But these should never dominate your portfolio. They're high risk. And approach alternative investments as a complement, not a core holding. Lastly, continuous learning and staying informed is crucial. Markets evolve, technologies change, and economic conditions shift. Following reputable financial news, analyzing trends, and educating yourself will help you make smarter investment choices over time. The 10,000 you invest today is not just about numbers. It's about developing the habits and mindset of a disciplined investor. By following these 6 strategies: diversification, high potential growth, tax efficiency, financial discipline, alternative assets, and continuous learning, you can turn 100 of 10,000 investment into a powerful stepping stone for long-term wealth. Start today, stay consistent, investment, and let your money work for you. When it comes to investing, a $10 in diversification is the cornerstone of a strong investment strategy. Too often, beginners fall into the trap of putting all their money into one stock or asset, chasing quick gains only to face devastating losses when that single investment underperforms. Diversification at its core, investment, is about spreading your money across different asset classes, industries, and even geographical regions to manage risk while still capturing growth opportunities. For example, investment. Allocating a portion of your 10,000 to a broad-based stock index fund allows you to benefit from the overall growth of the market without relying on a single company's performance. Index funds, investment which track the performance of large groups of stocks, are particularly effective for investors seeking stability and steady growth. Alongside stocks, it's wise to include bonds or other fixed income assets in your portfolio. Bonds tend to be less volatile than stocks, providing a buffer during market downturns. They might not offer the same explosive returns as high growth stocks, but their stability can protect your capital and provide predictable income over time. Diversification also extends beyond asset types. Within your stock allocation, for instance, you can spread investments across different sectors like technology, healthcare, consumer goods, and renewable energy. Each sector reacts differently to economic changes, so having exposure to multiple industries can prevent your portfolio from being severely impacted if one sector experiences a downturn. Similarly, investing internationally adds another layer of protection. Markets in other countries may outperform or underperform relative to your home market, and international exposure can smooth out volatility while capturing growth opportunities worldwide. It's not just about choosing different assets, it's also about proportion. A well-balanced portfolio typically combines growth-oriented assets with more stable investments, adjusting percentages based on your risk tolerance, financial goals, and an investment horizon. Younger investors with a long-term focus might lean more heavily into growth assets investment, while those closer to needing the funds might prioritize stability and preservation of capital. Another important aspect of diversification is understanding correlations between assets. Ideally, you want investments that don't all move in the same direction at the same time, because this reduces overall portfolio volatility. Lastly, diversification doesn't eliminate risk entirely, but it significantly mitigates it. By spreading your 10,000 intelligently across a mix of assets, sectors, and geographies, you create a safety net that can absorb shocks, reduce emotional decision making, and give your investments a better chance to grow steadily over time. This approach may not deliver instant windfalls, but it lays the foundation for consistent, sustainable wealth accumulation. By prioritizing diversification, you're taking a disciplined, informed approach to investing, one that maximizes potential while safeguarding your capital against unforeseen market swings. It's the first critical step in turning a 10,000 into a long-term financial powerhouse. Once you've laid the foundation with diversification, the next critical step is to focus on high potential investments that can drive meaningful growth over time. Investing isn't just about putting your money anywhere. It's about allocating capital to opportunities that have a solid chance of appreciating significantly, especially in sectors and industries poised for expansion in 2025. Emerging technologies such as artificial intelligence, renewable energy, and biotechnology are expected to lead the growth charts in the coming years. By carefully selecting companies or funds in these areas, you position yourself to benefit from long-term trends rather than chasing short-term market hype. When evaluating high-potential investment fundamentals matter more than emotions. Look for companies with strong balance sheets, consistent revenue growth, and visionary leadership. Avoid following viral trends or popular hot stocks that lack a proven track record. Research is your best tool here. Understanding a company's product, market potential, competitive advantage, investment, and financial health can dramatically improve your chances of success. For example, investing in a well-managed renewable energy company now can yield significant gains over the next decade as the world shifts towards sustainable solutions. While speculative hype-driven stocks may collapse just as quickly as they rise. Another strategy within high-potential investments is dollar cost averaging. Rather than investing the full 10,000 at once, consider breaking it into smaller, regular investments over several months. This approach helps minimize timing risk, reducing the impact of market volatility on your overall portfolio. Markets naturally fluctuate, and dollar cost averaging allows you to buy more shares when prices are low and fewer when prices are high, lowering your average cost per share over time. High potential investments are not limited to stocks alone. Real estate, for instance, can offer long-term appreciation and passive income streams, especially through real estate investment trusts, REITs, or crowdfunding platforms that allow you to participate with smaller amounts of capital. Additionally, some investors allocate small portions of their portfolio to alternative growth opportunities like peer-to-peer lending or even select cryptocurrencies, but these should remain a minor portion due to their higher risk profile. Patience is key when dealing with high potential investments. Unlike speculative trades that aim for quick wins, these investments require time to mature and reach their potential. Reacting to short-term market noise can derail your strategy. By maintaining a disciplined, research-driven approach and focusing on assets with real growth potential, you increase the likelihood that your 10,000 will compound into substantial wealth over the years. Ultimately, targeting high potential investments is about balance, taking calculated risks while relying on data, trends, and proven fundamentals. It's about positioning your money in places where the growth trajectory aligns with long-term global and economic shifts. With careful research, patience, and strategic allocation, this approach transforms your 10,000 from a modest sum into a powerful wealth-building tool. Another critical piece of investing 10,000 wisely in 2025 is leveraging tax-advantaged accounts and tools to maximize your returns. Most investors focus purely on picking stocks or funds and often overlook one of the most powerful growth accelerators available: tax efficiency. Good investment, paying less in taxes, isn't about cheating the system. It's about strategically using the options provided to investors to keep more of your hard-earned money working for you. Even a small difference in tax treatment can dramatically impact long-term compounding, turning what seems like a modest gain into a substantial fortune over time. One of the most effective strategies is utilizing retirement accounts such as IRAs, IIAs, or Roth IRAs. Traditional IRAs allow you to contribute pre-tax money, reducing your taxable income for the year. Investment. While your investments grow tax-deferred, Roth IRAs, on the other hand, are funded with after-tax dollars, but qualified withdrawals are completely tax-free. This means that every dollar you earn inside a Roth IRA grows without the burden of annual taxes, allowing your 10,000 to compound more efficiently than in a regular taxable account. Similarly, if your employer offers a 41(z) with matching contributions, this is essentially free money added to your investments. Ignoring the match is leaving immediate returns on the table. Investment. The combination of employer contributions and tax deferred growth can significantly accelerate your investment trajectory. Beyond retirement accounts, consider other tax-efficient investment vehicles. Municipal bonds, investment, for example, often provide interest income that is exempt from federal taxes, and sometimes state taxes as well. ETFs and index funds can also be more tax efficient than actively managed funds because of lower turnover, which reduces taxable capital gains distributions. By selecting the right mix of investments, you can maintain high growth potential while keeping your tax liability minimal. Another key consideration is capital gains planning. Long-term investments held for over a year are usually taxed at a lower rate than short-term gains. This simple strategy, holding your investments rather than frequently trading, can save thousands of dollars in taxes over time. Even strategic selling, such as harvesting losses to offset gains, investment, can improve your net returns. Finally, using tax-advantaged strategies also encourages a disciplined, long-term mindset. Investors who take advantage of these tools are more likely to stay invested, avoid impulsive moves, investment, and allow their money to compound over decades. By combining tax-efficient accounts with a diversified, growth-focused portfolio, your 100,000 can grow far more than it would in a simple taxable account. In short, investment, understanding and leveraging tax advantages is not just a bonus. It's an essential part of smart investing. By keeping more of your money invested, compounding over time, and reducing unnecessary tax drag, you set yourself up for significantly higher returns and a stronger financial foundation for the future. This strategy ensures that every dollar of your $10 is working as efficiently as possible. And before investing your 10,000, one of the most overlooked but essential steps is establishing financial discipline and maintaining an emergency fund. Many investors jump straight into the market, eager to chase gains, without ensuring they have a safety net in place. This lack of preparation can lead to disastrous decisions when unexpected life events occur or when markets experience volatility. Having a solid financial foundation allows you to invest confidently, knowing that short-term emergencies won't force you to sell investments at a loss. An emergency fund is your first line of defense. Ideally, investment. This fund should cover 3 to 6 months of living expenses, including rent or mortgage utilities, groceries, insurance, and any debt obligations. This reserve acts as a buffer against unforeseen circumstances such as medical emergencies, job loss, or major home repairs. With this safety net, you can keep your investments intact, allowing them the time to grow and compound rather than being liquidated prematurely in a panic. The peace of mind provided by an emergency fund is invaluable. It removes the pressure of needing immediate returns and helps you stick to your long-term investment strategy. Financial discipline goes hand in hand with an emergency fund. Investment. This means having a clear plan for how much of your 10,000 will be invested, where it will go, and how you will manage it over time. Discipline also involves setting realistic goals, creating a budget, and avoiding impulsive financial decisions. For instance, seeing a stock soar and feeling the urge to jump in without research is a common mistake. Investment discipline ensures that you make investment choices based on strategy and data, not emotions or short-term market noise. Another aspect of discipline is consistent monitoring and periodic rebalancing of your portfolio. Markets fluctuate, and your original asset allocation may shift over time. By reviewing your investments periodically, you can maintain your desired balance between growth and safety, adjusting as needed without overreacting to temporary market movements. This proactive approach protects your capital and optimizes long-term returns. Finally, combining an emergency fund with disciplined investing creates resilience. Life is unpredictable and markets are volatile, but with a strong financial foundation, investment, you are better equipped to handle setbacks without derailing your investment journey. This approach also reinforces patience, one of the most important traits for successful investors. By maintaining discipline and security, you give the $10 the opportunity to grow steadily over time. In essence, before thinking about high returns or complex strategies, securing your financial base and exercising discipline is the smartest move you can make. It provides stability, minimizes stress, investment, and ensures that your investments are positioned for long-term growth without unnecessary risk.